venture debt in US has always been between 15 to 20%, but that same figure in India has been in the range of 8 to 10%. So we believe that this is a very secular growth opportunity. So we started with a fund that just not focused in India, but also in Southeast Asia, because India and Southeast Asia markets are very similar in nature. And our experience has been absolutely great, because not only have we been actively investing in these markets, but our returns have been as what we had expected. It all boils down to various fundamental reasons which has led to the growth of private credit. Regulatory wise, after Basel III norms, banks are constrained to do certain forms of lending, which private credit players can, simply because of the regulatory arbitrage that Pranob earlier mentioned. Secondly, a lot of these financings that private credit player targets are often bespoke in nature, which require a lot of structural flexibility by the borrower, such as moratoria in terms of interest, principal, and oftentimes the repayments are also linked to certain events. It could be their follow-on equity funding, it could be listing, which is all something that banks cannot do. And finally, given the bespoke nature of these transactions, oftentimes you require a lot of nimbleness from the lender's perspective to ensure that if things go wrong, as you mentioned, private credit players are the ones who are best equipped to move faster to protect their collateral, as against banks who often have to go through an elaborate process, and by the time they decide to take action, there could have been a significant erosion in the value of the collateral. And therefore, in the long run, we believe, however, that the yields would start compressing. But today, I would say that we are in the Goldilocks zone, where the yields are high, the quality of credit is good, and the banks are still not very active in these sectors.
Private credit has been on a meteoric rise. Assets under management have risen fourfold over the last decade, and more importantly, this growth is only going to accelerate, doubling over the next 3 to 4 years. The rise in Asia from a low base is even stronger. Each new cycle brings new opportunities and, of course, risks. And to delve deeper into the world of private credit, I would like to welcome my fellow panelist, Pranob Gupta, who's the head of Lighthouse Canton's India Credit and Hybrid Alternatives business. Pranob comes with over 2 decades of experience in the business, in this segment, and has worked with KKR, 361, and JM Financial, to name a few places. And joining him is Ankit Agrawal, who's been running a very successful private markets asset management business at Lighthouse Canton, over a decade of experience across the capital stack and across equity, debt, venture debt. And Ankit has worked with GIC and IFC in the past. Welcome, gentlemen.
Great to be here. Great to be here.
So let me start with you, Ankit. You've been running a very successful venture debt business in India, and you've got a lot of experience in the private markets. Talk to us about the journey and why is this segment growing so strongly and at this point in time?
Sure. So Sunil, we launched this fund almost 3 years ago. And before we launched the fund, we studied the market for almost a year. If you look at the venture debt market in the US and compare that with the India, the venture debt in the US market is far deeper and far larger as compared to Indian economy. Perhaps India is where US was 2 to 3 decades back. And if you look at venture debt penetration, the way it is measured is as a percentage of investments happening, as a percentage of the VC market. Venture debt in US has always been between 15 to 20%, but that same figure in India has been in the range of 8 to 10%. So we believe that this is a very secular growth opportunity. So we started with a fund that just not focused in India, but also in Southeast Asia, because India and Southeast Asia markets are very similar in nature. And our experience has been absolutely great, because not only have we been actively investing in these markets, but our returns have been as what we had expected.
Fantastic. I'm going to come back to you on the secular growth aspect. But Pranav, you've been involved in a number of transactions over your very long career. Talk to us as to what's making the borrowers go to the private markets as opposed to the traditional forms of funding, whether it's banks or the bond market?
Sure, Sunil, and again, thanks for having me. From a perspective of private credit, let me just throw up some quick aggregates, right? We're talking about Asia making up 35% of global GDP, but the private credit market in Asia, as opposed to basically the global private credit market, is only 6 to 7% of the global private credit market and growing the fastest, as you might imagine, globally. It's being driven by two borrower needs, really. One, in terms of what is loosely under the umbrella of regulatory arbitrage. So what that means is that banks, by regulation, across jurisdictions, cannot do certain things, right? To put it simply, things related to capital markets exposure, things related to perhaps a land purchase, things related to sculpting a deal in terms of basically being a little easy in terms of cash flow and moratoria, things related to asset-light business models, let's say financing a SaaS company, or let's say an EPC company, right? So that's one universe. The other basically is in terms of essentially looking at exits that are not necessarily linked to an intrinsic cash flow of a business, but linked to, let's say, an event. For example, the sale of an asset, the probability of an IPO of a company being high and therefore borrowing against it, right? So these are kind of event-driven exits, right? Basis which private credit has effectively seen a very significant growth.
So a lot of the growth is in the specialty finance, if I can use the term, right? And a very specific case, Ankit, has been the startup business, and you've obviously been very heavily involved in that. Do you think that segment can only be served by the private markets, especially private credit?
So Sunil, again, I'll go back to my earlier answer. If you look at India market and compare that with the US, today the largest private credit player in the US markets are venture debt funds. In fact, most recently, even mature companies such as Meta, who are going into uncharted territories such as building out GPUs for AI models, have approached private credit players for their largest ever debt raise. So today the largest venture debt players in US are venture debt lenders and not banks. And we believe that similar scenario will play out in emerging markets such as Southeast Asia and India for similar reasons what Pranob earlier mentioned, that you are essentially lending in companies which could be asset light, are coming up with new regulations, and therefore banks do not want to enter into those sectors.
But let me just stay on that for a moment, right? When there's a good thing going, everybody wants to jump onto the bandwagon. How realistic is it to believe that the traditional financiers are going to stay out of it? After all, this is the fastest growing part of the market.
Again, it all boils down to various fundamental reasons which has led to the growth of private credit. Regulatory wise, after Basel III norms, banks are constrained to do certain forms of lending which private credit players can, simply because of the regulatory arbitrage that Pranob earlier mentioned. Secondly, a lot of these financings that private credit player targets are often bespoke in nature, which require a lot of structural flexibility by the borrower, such as moratoria in terms of interest, principal, and oftentimes the repayments are also linked to certain events. It could be their follow-on equity funding, it could be listing, which is all something that banks cannot do. And finally, given the bespoke nature of these transactions, oftentimes you require a lot of nimbleness from the lender's perspective to ensure that if things go wrong, as you mentioned, private credit players are the ones who are best equipped to move faster to protect their collateral as against banks, who often have to go through an elaborate process, and by the time they decide to take action, there could have been a significant erosion in the value of the collateral.
Pranav, let me ask you a question on that last point Ankit just talked about. So are private financiers more fair weather friends because they'll pull out at the first sign of trouble, while the banks will stick on because perhaps they have to go through processes?
I will sort of want to look at it through two lenses, right? In terms of an imperative, right, in terms of effectively not being part of a conglomerate but being an independent asset manager, in terms of, I would call it the ability to pull a trigger, I think private credit is much more unconstrained, right? Mm-hmm. So in terms of being able to enforce on collateral without considering what X or Y business within the same conglomerate would do, I think private credit gives a lot of, I would say, latitude to the lender. Having said that, let's also remember where we started off, right? That private credit is fundamentally a flexible form of capital, right? If I am lending to a company, or let's say to a holdco of a company, right, and it is likely to IPO within 6 months, I think it is within reasonable probability that even with, various things being baked in, that it would IPO within, let's say, 2 to 3 years, if not 6 months, right? So if I do give them that duration, rather than giving them a 6-month bullet loan from a bank, my likelihood of getting into trouble in the first place, is significantly nullified, right? That's been our experience.
Right. And, Ankit earlier talked about a secular trend, right? I know analysts are very fond of making projections which always just seem to go up. But, I often hear that this is a structural trend. Talk to us about why you think this is a structural trend. What makes it so indestructible, irreversible?
So the way I think about it, just taking a few aggregates, maybe in the Indian context for a change this time, the Indian market is about $4 trillion or thereabouts in terms of overall credit. Within that, private credit, as we define it, forms a minuscule $25 billion. It is expected to reach $70 to $80 billion by the end of the decade. While that is a very significant CAGR, even at that rate of growth, it constitutes less than, let's say, 2% of the overall credit market in India. So we are meeting a need, but we are meeting a very small sliver of that need overall. Secondly, if you look at exposure itself in private credit, I think lenders have become smarter as well. When we look at some of the sectors that have traditionally posed duration risks, for example, metals and mining, real estate, certain parts of very growth-oriented and execution-heavy infrastructure, we have found that both the exposure of existing private credit funds as well as new launches of funds which are specifically focused on these categories have gone down very, very significantly. It is also worth remembering, Sunil, that in the backdrop of what is today, right, and this is pan-Asia, by the way, capital adequacy ratios of banks are at probably decadal highs, right? NPAs, GNPA, NNPA are at decadal lows, right? It would be incorrect to say that private credit is sort of, assuming the bogey of basically a banking crisis or a banking contagion. It is clearly coming out of an intrinsic need of borrowers and a very wide borrower class in terms of the need that it is meeting, right? And when an asset class is sort of, seeing this sort of absorption and stable metrics, right, I would tend to feel that there's something really structural going on here.
I'm probably going to do a survey at the end of it to figure out whether this is how people feel about the secularity of this trend. But you talked about the growth opportunity in India. Ankit, you've been involved much more in Southeast Asia. Talk to us about the opportunity more broadly in Asia, and especially in Southeast Asia.
So we see Southeast Asia market as very similar in a certain way to India, in the sense that private credit is highly underpenetrated and most of the companies today look to be serviced by banks. So naturally, in terms of scope of growth of private credit, it ranks almost at a similar levels, if not higher, as compared to India. However, if you look at Southeast Asia as a market, each country is quite unique in nature, unlike in India, which has far more uniformity in terms of demand and consumption patterns. Whereas in Southeast Asia, it's a bouquet of countries such as Singapore, which are far more developed as compared to, let's say, Indonesia. And then you have countries such as Vietnam and Philippines that are far behind in terms of their development growth. So what we've seen is that in Southeast Asia, the sectors that demand private credit are quite different. You would see, simply because of the growth that these countries are seeing, demand for financial services being far more higher in countries such as Philippines, Vietnam, as compared to, let's say, Singapore, which are already seeing a good amount of credit offtake from the consumers. Okay. And then you have countries such as Indonesia, where it's a mini India in the sense that you have a young middle class, a fast growing market, and naturally the country itself is growing very rapidly. So we see growth of sectors such as EV, simply because Indonesia so far has relied on fossil fuels for all its mobility needs. So the markets separately are quite unique, but together the penetration of private credit plays a similar story as what we are seeing in India.
So Pranob, you earlier talked about the growth in specialty finance. Ankit talked about some of the sectors which are very amenable to growth. Which sectors do you think are the ones that you would want to avoid in terms of private credit? Are there any exclusions you have, for example?
In our mandates in general, and of course this is open to various viewpoints and underwriting skills, capabilities, track record, etc., we tend to avoid cyclical and commodity linked sectors. Okay. And the simple reason therein being that if there is fundamentally an unhedgeable commodity price as an underlying, something that could be 100 one day, could be 300 the next, could be 33 the third, right, is something that we would generally avoid, right? If we cannot underwrite either cash flow or asset or equity value, right, that fundamentally is something, or within, let's say, a certain, I would say, range of confidence, right, confidence interval, that's something that we'd probably pass up.
Fair enough. I'm going to turn the discussion a little bit more towards thinking about risks, right? Because every opportunity has a flip side. Pranob, talk to us about why borrowers go to the private market and pay up higher interest rates compared to perhaps traditional financing. Is it kind of an automatic negative selection? You can't get funding from a traditional source, so you're going to a more expensive private credit market?
I think, Sunil, the word negative selection by implication has a negative connotation. So I would, sort of dodge that one, right? I have 2 points to make here, right? One is that fundamentally, if the bank market is tapping out at, let's say, in Indian rupee terms for a moment, right? Just staying with one local currency, 12-13%. Then fundamentally, if you cannot access bank credit, you are saying that I need to borrow at 14, 15, and the risk premium keeps growing depending on complexity and size and cover and whatnot, right? That's one part of the coin. The other is the principle of arbitrage, okay? But this time I'm talking about arbitrage from a borrower's perspective. Let's say my company is growing at 25% CAGR, equity compounding for a moment, right? Which means that give or take my company is, doubling equity value in about 3.5 years. It might make sense for me to borrow money at even 18 to 20%, okay? Rather than give up that 25% compounding. So effectively, I'm conserving my equity return in the business as a promoter and paying up something on the debt, right, with a positive carry on the underlying, right? And so to that extent, right, it is very, very important to, think about, sort of the predictability of the outcome that one is achieving through taking that private credit financing in and as of itself. In the context of, without sort of a background, right, and 18 looks high, but when you think about, the kind of ROEs that some of these businesses have been making, the kind of equity value that's been generated in India, across Asia in the last, let's call it, decade and more actually. I mean, one data point, Sunil, that we've talked about offline, Indian equity market capitalization, 1.5 trillion a decade ago, 5.3 trillion today. Number of IPOs this year, 110 year till date, 15 IPOs all of the year, about a decade back. So things are changing very fast, right?
Right. And Ankit, every bit of data that I see shows very low credit losses, right? Now, I don't know of any form of lending which doesn't have credit risk, right? What makes the private credit markets so special? What's the secret sauce as to why you private credit financiers just don't see the kind of losses the banks do?
So there are multiple reasons for that. Credit losses are also a factor of the vintage as well, correct? And private credit undoubtedly has been relatively new compared to bank lending. So
Sure.
The data perhaps is available in emerging markets for perhaps 15 years or so. But the good part is that 15 years has seen a lot of events, including COVID, which has tested private credit's capability to withstand such shocks. I think fundamentally it boils down to reasons such as what we have earlier mentioned, that private credit players are far more nimble and flexible in terms of resolving any stress or working with a borrower to structure the loan so that you don't get impacted because of any unforeseen events. A very simple reason again here that I would talk about is, let's say if a company, the repayment is dependent upon an IPO. If there is an IPO delay, a bank would typically start making provisioning because they follow by strict norms that if there is a delay beyond a certain period, they start making provisioning, and then they have to follow their internal processes, which is, they start provisioning, they start reporting to their bank management committees, then they start taking legal action. Whereas private credit players are far more flexible. They know when there is a genuine reason for stress and they are not very trigger happy in all situations. Of course, when the situation demands it, they would move very quickly. But if it requires patience, then they would prefer to be more conservative as compared to banks. Oftentimes, what we've seen is as long as the quality of the collateral is good, it's in both parties' interest to come up to a resolution of the company, because at the end of the day, you recover capital only if the company survives. However, just for the sake of legal action, if you start taking measures, then it's a loss-loss scenario, which often happens in a bank, but not in private credit.
So nimbleness plays a role, and you briefly touched upon collateral, right? And Pranob, you've written about how collaterals played such a big role. Talk to us about that.
Sure, I'll touch upon maybe two dimensions here, both collateral and counterparty. From a collateral perspective, there are very clear norms in terms of course, being senior secured. We do not do sub-debt. We, of course, do not do unsecured structures. We require clear mark-to-market, not just a valuation report with regard to collateral, right? No matter what the source or antecedent of that valuation report is. Let's say 2.5 times of listed share cover, 3.5, 4 times of cover if it's more illiquid shares or maybe hard assets, etc. We're also very concerned about counterparty selection, right? In jurisdictions where enforceability is still, WIP in many ways, right? It is important to recognize that willingness to pay perhaps matters much more than ability to pay in certain circumstances. Because if a borrower, a promoter group has willingness to pay, he will move heaven and earth even in a crisis. We've seen this through global financial crisis. We've seen this through localized events like demonetization in India, etc., or COVID for that matter, wherein basically a borrower would move something in the group. Maybe he'd monetize a very valuable asset. Maybe he'd bring back something from offshore. Okay, maybe he'd look at basically selling his crown jewels in a listed company, right, in order to pay off, let's say, some obligation. While on the other hand, Asia is replete with situations wherein there are, as we say, wealthy promoters and insolvent lenders, right, especially at holdco stacks, right. So we're very, very careful about counterparty selection as well as cover analysis.
Okay, very quickly, both of you have talked about regulatory arbitrage. What's the risk that the regulators start to get their eyes on this part of the market and start posing restrictions? It wouldn't be the first time regulators have wanted to control things. I mean, Ankit, do you think that's a possibility?
No, that's a very real possibility, especially when you look at the tech sector. And again, here I will go to India. Simply because that's one of the largest markets in this region. We have seen regulatory crackdown in multiple new sectors. Most recently, there was ban on real money gaming by the Indian regulator. Then we've seen them coming very heavily on fintech companies through revised norms. And then we've seen a lot of regulatory action even on the electric mobility or electric vehicle sector towards companies. So the regulatory uncertainty is very clear. It's very sure that it's going to happen, and that's primarily actually one of the reasons why banks also avoid lending in sectors which are relatively new. They want the regulations to settle down before they come up with a lending strategy in these sectors. But because private credit players are far more nimble and they have a more on the ground awareness, private credit players can still take that risk. However, there are still certain sectors which are a no-go. For example, gaming, crypto, all of these sectors which historically have been under heavy regulatory watch lists globally, have been typically avoided by private credit players. So typically we always look up to mature markets when we are lending into new sectors to see what was the regulatory actions taken in those sectors before we go into them. And also we constantly interface with the regulator on what level of view do they have on those sectors. Is it a positive bias? It's a negative bias. And depending on that, we decide whether we want to go deeper into that sector or not.
Understood. Let me turn the perspective a little bit from an investor lens, right? At the end of the day, obviously, I look at it a lot from an investor perspective. And Ankit, one of the things that happens in any industry is it's growing very fast, new entrants come in, returns get compressed. What do you think is the probability of more people just coming and competing away some of the returns that investors get in private credit?
Like any industry, it's a factor of demand and supply. So naturally, if the suppliers of credit increase, then the yields are going to compress. And we are already seeing that in the global markets. The good part is today in India as well as Southeast Asia, the penetration of private credit is very small. And therefore, in the long run, we believe, however, that the yields would start compressing. But today, I would say that we are in the Goldilocks zone where the yields are high, the quality of credit is good, and the banks are still not very active in these sectors.
Fantastic. And Pranob, as an asset allocator, I have to often make a choice in investor portfolios between putting investors into bonds. I'm talking about the fixed income allocation. But given the returns in private credit, very low default risk, do you think I should just be ignoring bonds completely and put all the fixed income allocation into private credit?
My short answer is absolutely not. Don't do anything of that kind. The way we talk about alternates allocation to clients in general, of course, again, this requires more, curated advice, but it's typically not more than 10% of a given client portfolio in an asset class. In a given fixed income portfolio, which could be, let's say, 40 to 60% of a client portfolio, we'd advise not more than 4 to 6% exposure to alternates. Alternates will bring you diversification. It will bring you, in that sense, a dislocated risk reward and access to typically more institutionally backed opportunities, which the classical, let's say, non-institutionalized investor may not have. However, it will bring duration, it will bring illiquidity, and it will bring, I would say, the need for some degree of sophistication in terms of understanding, or at least having a basic, I would say, appreciation of the underlying that you are carrying, right? Which we do not advise all investors, all and sundry investors to take on, right? So definitely, private credit, very interesting. Please, do lean in, but in a very, very measured fashion.
So my bond market analyst can breathe a sigh of relief.
Oh
in
yes,
that case.
for a long time.
Absolutely. And Pranob, you talked about a lack of correlation. Ankit, talk to us about that. How truly uncorrelated is this asset class, and what makes it so uncorrelated?
There are two key reasons. One is that most of the private credit transactions, again, I'm talking about Southeast Asia and India, these are on fixed return basis. That is, irrespective of whatever the treasuries or the Fed rates are, the returns are guaranteed for the tenure of the transaction that we are doing. And therefore, naturally, that interest risk component goes away. The second is simply because of the illiquidity nature of the product. There are very low MTMs that happen in this, and therefore the price risk is also very low. So I think fundamentally these are the two reasons why it is said to be uncorrelated. However, there are also a couple of parameters that drive the uncorrelation. The first one is the bespoke nature of the transactions. There are certain reasons why investors are lending to a company, and oftentimes these repayments are event driven. It could be acquisition financing, it could be bridge financing to a subsequent equity round, and all these events are not linked to what's happening in the global markets. Secondly, there are certain, again, fundamental reasons why you are lending to a company. It could be against an asset, it could be on back of an equity funding, and therefore these reasons are why private credit as a product is uncorrelated with the global market.
Okay, I'm going to ask some really quick questions. Ankit, when you're looking for opportunities, what's the top 1-2 things you look for when making a decision?
The first one is naturally the size of the market, because we don't want to go into sectors which are heavily borrowing from banks. And in this sense, it would mean, lending businesses or, NBFCs, non-banking financial companies, which are quite rated and have access to bank credit very easily. So we go towards companies that are fast growing and are struggling to raise debt simply because they don't meet the credit or the rating criteria of some of the banks who prefer larger companies. The second is, what is the quality of the counterparty and what is the level of institutional backing that counterparty has, because we only go into companies that have raised some capital from institutional investors, be it private equity, sovereigns or venture capital funds. So for us, that is the second paramount factor which we take into consideration when we are looking into transactions.
And Pranav, very quickly, what are the big red flags, pitfalls to avoid in making decisions?
I think first and foremost, counterparty selection. I mean, just to take from Ankit's point and what I mentioned earlier, if you've chosen your counterparty wrong, we've done some work on it, by the way. Of the 100 defaults that we've seen in our target market, about 80-85 tend to be from wrong counterparty selection, because the behavioral aspect of how a promoter or a counterparty behaves, especially in a crisis, and typically credit markets do tend to be cyclical, so you do tend to see some crisis in the rear view mirror, right, is very, very important from our analysis perspective. Of course, we bring the full, bouquet of skill set in terms of rigorous analysis, due diligence, reference checks, a diligence which I would say is analogous to essentially a private equity investment process, and an asset monitoring, which is again analogous to an investment process that would be as rigorous I would sort of submit as a bank or a private equity investor, right? So there is no letting go of that, but I think the starting point is very important.
Fantastic. So as we've seen, the private credit market is not only grown in a fantastic secular fashion, if I can use the term. I think the outlook looks equally bright, and particularly when we talk about underpenetrated markets in Southeast Asia and India in particular. This is an asset class which I think is attractive for investor portfolios, certainly as a diversifier, certainly as a non-correlated asset. Thank you, and thank you, gentlemen.
Thank you,
Thank you very much.